back again at another $1 Insight here again with the amazing Shan Saeed from GYIQI, Chief Economist here, Global Economist we should say. And we are moving forward again. And you know, we're very excited, Shan. You know why? We got some questions from our audience, our followers, that they would really love to ask you. Is that okay for today?
Yeah, fantastic.
Shall we get started right away?
Absolutely.
Because if we want to go through all the questions, I don't think we have enough time. But we picked out the top, let's say, questions from our audience. And we hope that we can get all of the questions in there. So, first of all, Shan, how are you?
I'm fantastic. How about you, Taco?
Yes. If you look at the global economy right now, are you excited? Are you positive? Or are you kind of like looking at it as, you know, I don't know what's going to happen?
In my opinion, for 2025, I'm cautiously optimistic.
Good.
That economies will expand
Yes.
With a caveat that interest rates would go down
Yes.
for many economies, especially the advanced economies. Once those advanced economies will come out of that slow growth
Yes.
and they move into growth mode, so that will give momentum.
Great.
So that once you get the momentum, yes, other economies will follow suit. So I think, in my opinion, I'm cautiously optimistic. Yes, there are limitations in every situation,
Yes.
but hope for the best.
Fantastic. Okay, cautiously optimistic. What I really want you to know is that we have got a question from Lee. Thank you, Lee, for your question. He says the interest rate outlooks. Are we heading to an accommodative monetary policy regime globally? What is your analysis on the central bank's policy outlook?
Yeah, that's a very good question. Thank you for having this question. In my opinion, with the global economy going into 2025, policymakers have already decided that they will bring down the interest rates. The reason is inflation is coming down. Inflation is down, that's why it gives a lot of room for central banks to maneuver and to bring down the interest rates so that economies can expand, businesses can flourish, consumers can spend more, and ultimately this generate the growth for the economy. So economies run on two major variables. You have four variables in a GDP equation. You have consumption, you have investment, you have government, and net of export. But two factors are very important. One is consumption,
Yes.
and the other is investment.
Yes.
If these two factors are strong, this will give momentum to the other two factors. So I think what the governments are focusing globally and the central bank, they want to focus on consumption and they want to focus on investment.
Yeah.
So once these two variables, they go into the momentum at the macro equation. So I think that gives a lot of confidence to policymakers to make a lot of maneuvering, not only in monetary policy, but also in the fiscal policy. So in 2025, we will see an amalgamation of monetary and fiscal policy. Government will be using a lot of money to expand, and the businesses will be, using a lot of money to invest. So it will be a combination, amalgamation of monetary and fiscal policy to spur growth for many regions in the world.
Fantastic. And what does that overall also mean for, let's say, equities, for real estate, for example, right? We're a real estate company. What will you see that will affect the results heavily when interest rates come down and the changes will be made? You said on a step-to-step basis, right? But what would that mean for, let's say, the equity market, real estate on a global level?
Taco, that's again a very good question. Once the interest rates come down, what happens to the market is we follow the debt market. So what is debt market? I try to explain to your viewers. We at GYIQI, we follow the debt market, the bond market, the fixed income market, because that determines the outlook for many asset classes like commodities, equities, real estate. Once the interest rates go down, the yields also go down of the bond market. Once the yields go down, it sends a signal to the market that real estate mortgage rates will come down as well.
Yes.
Once the rates they come down, it will give momentum to commodities, because most of the commodities, 90% of the commodities are traded in US dollar. So once US dollar stays low, it stays weak, the commodity prices will go up.
Yes.
So real estate equities, I am bullish, because a lot of equity investors, they sense the moment the interest rates are down, they park their funds in the equity markets, and that's how the momentum is generated in that asset class. So equities I'm bullish, real estate I'm bullish, because mortgage rates will come down, and of course commodities.
Fantastic.
So these three asset classes will remain in the global investors radar for the asset portfolio.
Fantastic, fantastic. Well, that's good news, right? On a global level, right? That seems like economy moving forward, right? Growing again after years of high inflation, high interest rates. So, like you said, optimistic, cautiously optimistic. I like
optimistic.
it. We got another question, Shan, from Shannon. Shannon is a bit concerned about the geopolitical risks and everything that's happening around the world. Is asking what is the impact of geopolitical risk on the markets at the present moment? You know, especially when it comes on pricing and everything that we need to prepare for.
Taco, again, if you see in the last 17 years, the alchemy of financial markets has changed dramatically. The ructions in the market are of a magnitude not seen in a generation. So these exogenous factors, these geopolitical risks, higher interest rates, supply chain disruption, something, red flags happening. So these are those factors that are not accounted for. These are they are like unclear. They are not very open to everyone. So once these geopolitical risks, they come into the macro equation, you are taken off guard. So you don't know how to strategize. So right now, with reference to this question, I would say the geopolitical risk is very unpredictable, it's uncertain, and above all, you can't really make a forecast on the geopolitical risk because it is not in the macro equation. So once a variable that is outside economics, it's very hard to predict about that variable, how it will make an impact. But in the last 3-4 years, we have seen the geopolitical risk, it makes a huge impact. Number one is oil and gas. The moment you see geopolitical risk, especially to those countries which are quite aligned to oil and gas, supply chain disruption comes first. You have risk premium in the oil market, and above all, investors, they get panicky. So once you have these three variables, obviously it will send negative signal to the market. So once you see investors are panicking in one asset class, it goes to the other asset. It has a spillover effect on other asset classes as well. So I think geopolitical risk, it remains there in 25, 27, 25 and 26. How to prepare yourself? You have to have scenario analysis. You need to have plan A, B and C. What plan A doesn't work, you have to go to plan C for your asset portfolio. What if plan B doesn't work, you go to plan C for your asset portfolio. So I would say real estate, commodities, arts, agriculture would be those asset classes that can give you wealth preservation. And as we said, IQI, real estate has become the new global currency. So if you want to have peace of mind, if you want to have tangible results, if you want to have smart capital returns, so I would say take position in real estate, take position in gold and silver, arts and agriculture. You will be having wealth preservation and you will have peace of mind.
Fantastic, fantastic. And to add to that, you say, what did you call it? Scenario
analysis.
And scenario analysis. So have actually 1, 2, 3 plans ready. Like if this happens, then you follow through with this. So have a very clear direction, clarity for yourself on the steps that you should take. I like the idea of real estate being the global currency. One of the things that you see a lot around the world that I would like to ask you, Shan, from my personal level, is that I have a lot of friends that have invested heavily in real estate in Europe. And two things are happening in Europe right now where there's a lot of new government policies on ownership in Europe because of inventory issues, right? The new first hometown buyer cannot buy real estate because it's either not available or it's too expensive. So they're trying to push the prices down. And second, on a lot of short-term rentals, they're imposing extremely high taxations. So looking at that, like you're saying, real estate is like a global currency, and I like the word global, right? What would you say to, let's say, the European investor, specifically the European investor that is dealing with very heavy government policies, high taxations? They have saved a lot of money over the, let's say, last 20 years, right? What should they do? What are alternatives for them that they might not have thought about on a global scale?
Thank you. It's a very interesting question. And I still remember 20 years ago, nobody was talking about globalization. It started at that time. But now everybody is talking about globalization. So investors, they need to look global. You cannot be country-centric. You need to look at other countries. You need to look at what is happening in Singapore, or what is happening in London, or what is happening in Dubai, or what is happening in KL, or what is happening in Vietnam. So when you look at these cities and countries, it gives you an idea why investors are moving over here. Number one, the taxation is very low. Number two, the government policies are very structured and they don't run on ad hoc basis.
Yes.
So policy consistency is number one.
Yes.
Number two, the rate of return. The rate of return over here in this part of the world, they're pretty high.
Yes.
Because investors' confidence in this part of the world is pretty high.
Yes.
So investors, they need to look at those regions which are booming. They cannot remain at one place. If you remain at one place, you become stagnant. Once you become stagnant, you're not growing. So coming back to your point, having very high taxation in Europe and very difficult for those first-time buyer to buy properties, I would advise them to look global. Go global and explore opportunities. Go to Thailand, come to Malaysia, go to Vietnam, Indonesia. There's so many options, Philippines,
Yes.
and see where the real estate market is strong.
Yes.
And try to relocate yourself in other parts of the world when you don't find enough opportunities in your own region.
Yes.
I still remember Jim Rogers said in 19th century everybody was heading to New York.
Yes.
In the 20th century in the 19th century everybody was heading to London.
Yes.
In the 20th century everybody was heading to New York. In the 21st century everybody is heading to Asia.
Yes.
So if you're not in Asia, you're not in the right continent. Europe right now, whether we like it or not, I know you're from Holland,
Yes.
is slowing down. And economies, they don't grow when investors' confidence is low.
Yes.
Investors, they would like to move away from those regions which are slowing. Germany is slowing down, Spain is slowing down, other parts of Europe are slowing down. Investors' confidence pretty low.
Yes.
So I would advise those first-time buyers, look to those opportunities, to those regions where opportunities are high, and there are potential opportunities everywhere.
Yes.
But where the investors' confidence is high, that's where you can grow your money.
Yes. Funny note, recently I learned through friends of mine in Europe, right? They own property in Italy, and they were doing that for short-term rental, right? With making just not crazy amounts of money, but just like a nice 2 properties that they rent out for short term, and then sometimes in the summer they use it by themselves. And suddenly the Italian government comes with a new taxation for every short-term rental that they have to pay 24%. Right, so almost a quarter of your money that you're making now has to go back to the government, and on top of that, the cost of maintenance, management fees, all of those, because of inflation, are also increasing constantly. So do you see, looking at Europe as a whole, I'm talking about Italy as a specific example, but looking at Europe as a whole, where is the direction of Europe? They have these issues of geopolitical, they're kind of between the West and the East, between the giant, the US, and the other giant of China, somehow smack in the middle. I know that the globe is round, but kind of in the middle in how we look at the map. What are their options? Where are they going?
The options are very limited.
Yes.
Europe has become a sandwich between geopolitics and geoeconomics. So how do you balance these two variables? Geopolitics is very important and geoeconomics is very important. Mm-hmm. But in my opinion, if you can manage your politics well, you can manage your business.
Yes.
You cannot manage your business first and then you can manage politics. The politics has to be managed first, you know.
Yes.
They need to maintain macroeconomic stability.
Yes.
So when I talk about macroeconomic stability, it means political, economic and financial. Once you have macroeconomic stability, then the economic stability comes in.
Yes.
So Europe is in a, if I were to say, it's in a very tough position right now, how to manage geopolitics. The exogenous factors are not in their favor, and how to manage geoeconomics, where a lot of people are leaving Europe.
Yes.
And they don't have confidence in their governments.
Yes.
So once you don't have confidence in the government policies, then it's very difficult for the governments
Yes.
to manage many variables. A lot of variables are outside the jurisdiction of Europe. They
Yes.
cannot really manage.
Yes. Interesting.
So the governments are in a catch-22 situation, I would say.
Shan, you know the old saying of global investments, right? Was always developed markets like to invest in emerging markets, and emerging markets like to invest back in developed markets.
Yeah.
However, with the geopolitical issues, with these taxation issues in Europe, with the tariffs between, you know, what the US is going to impose on China, Mexico, and all of the other exporting countries in the world, does a statement like that still hold to truth? Right, that emerging countries would invest in developed countries. Would emerging countries not look more to other emerging countries rather than the very expensive developed countries with all their tariffs, taxations, and very strong government policies? What's your take on that?
Yes, the emerging markets will continue to invest in advanced economies despite they are very expensive, because those markets are very mature.
Yes.
Those markets are well positioned. They are very disciplined markets. US equity market is one of the largest. So whether you like it or not, you say, no, I don't want to invest, but still it is a market that is growing.
Yes.
So this year alone, YTD, the equity market growth has touched over 26%.
Mm-hmm.
That clearly reflects the US equity markets, despite all challenges, despite geopolitical risks, despite governments' unpredictable economic policy, the equity markets are still soaring high like a beautiful eagle.
Yes.
So, you know, you have to invest where you can make money, where the valuations are still very strong, the PE ratio is still very high, but still investors, they have confidence in the US equity markets. But on the other hand side, emerging economies are also growing.
Yes.
And investors, they would like to, they take leverage from that economic growth. So that's why you see a lot of investment is coming to Vietnam,
Yes.
Malaysia, Philippines, Thailand, you know, or India, because these economies are growing. China is still growing. Yes, China has slowed down, but still investors, if you look at it from the macro perspective, China still offers a lot of opportunities to
Yes.
those companies who can tap in those 1.47 billion people.
Yes.
So in my opinion, yes, the funds flow will remain. Emerging economies, advanced economies, and businesses will tilt where the growth opportunities are higher.
Yes.
So I still favor emerging economies for growth parameters, but for equities, I still prefer advanced economies like US and Europe.
Fantastic, fantastic. And you know, those are the questions that we had for today. I would like to thank you again, Shan Saeed, our chief economist, you know, being here. I think you got some really great takeaways, you know, moving forward. And we're just looking forward to the next episode again, right? So if you have any questions, put them in the comment box, send them to us by email, send them to us by WhatsApp. You will know how to find us. You can find Joy IQI everywhere, and all of our amazing people here at Joy IQI will make sure that these questions come to us, and then we will address them again on the next episode here, $1 Insight.
Absolutely.
Yes?
Yes.
Shan, thank you so much for joining me here today. Thank you for joining us here today, and we will see you again next time. Have a great day. Bye-bye.
Bye-bye.